Hello friends, how are you doing? In this video I'm gonna do something I have been wanting to do for a long while now already, which is to open up to you guys how I go about my research process in searching for those stocks I want to buy, those companies I want to own. I think this video will be especially important for all of those beginner investors out there, which we all have been at least once when we first start investing. And with this video I'm gonna show you a nice chart that looks like a total mess, to be honest, but I'm gonna explain it to you once we move forward. And I hope this video can help some of you beginner investors out there to define and create your own research processes when it comes to looking for good companies to own, stocks to buy. Obviously, pretty essential part of successful investing. So without further ado, let's go. So here it is, the total mess I promised to you guys. This chart, don't get scared now, it looks ugly, I know, but I will explain it to you once we move forward. We're going to begin from the top, from the three blue boxes, and we are going to keep on moving downwards all the time. So basically this a process for looking for good companies to own, stocks to buy. This is divided in 4 different phases, which you can see on the right hand side. First there is idea generation phase, then study phase, followed by decision phase, and eventually portfolio management phase, when the stock has already been bought into the portfolio. But first we're going to start from the top. You see those 3 blue boxes. These are the places to start. So where do I actually get an idea of a stock I want to own, or a company I want to own, to be more precise, because I don't kind of like the word stock. It sounds too much like some stock investing game, and this is not game. This is you actually owning real companies in real world, so let's call them companies for now. First place where I can go looking for is observing the world around me. You know, your everyday life. You go to work, you probably have some cooperating companies you work every day. You get to know those companies, then you start seeing that this might be a company I want to invest in. Or then you are just walking on the streets, seeing a new pizza place pop up, and for some reason everybody's hyped about it, everybody's going to that new pizza chain all the time. Then you start finding out, why is this so popular, what are they doing differently than their competitors. Or you can just have a chat with a friend who starts telling you about a great product he or she is using, or a great company, if your friend is an investor, your friend came across. So basically this is very Peter Lynchian stuff, just checking out what is around you, observing things in everyday life, can be, or I would rather say is the best place to look for companies to own. Then the second blue box in the middle, ideas from other investors. Here I don't mean my friends anymore, but super investors from Dataroma, other investors writing blogs online, or then my favorite place to go looking for other people's opinions, YouTube obviously. So you can get ideas from other investors, and investing is a cool game, by the way. It's not like a high school test you need to take, which you are not allowed to look at your neighbor's paper, but in investing you are allowed to copy ideas. You are allowed to do shameless cloning, as Monish Pabrai would say it, in your portfolio. So nothing to be ashamed in cloning, in copying. In investing game that is acceptable, and I actually encourage you to do so sometimes, because when talking about your own conviction, how sure I am that this stock will go up eventually, by telling my own, obviously I want to trust my own valuation I have made, my own research I have made, but I can tell you and give you a little secret that it feels much more comfortable when you know other investors you think are great, you value a lot, they have ended up in similar conclusions as you. That will give you some extra conviction, which is which is what every successful investor needs. You need to have conviction in your picks, in your companies you own. Unless you don't have conviction, you don't know what the real valuation is. You will get scared when the market starts going down and funny things start happening. You will get scared, and when you're scared, you will do stupid things, and we all know that will not end up in good profits. But let's move forward. The third blue box, top right corner, screener search. There are many platforms online, websites online, some probably free of charge, but some cost. For example, the one I'm using, ticker.com, that costs me something, but they have a great global screener where you can set up criteria. What do you want to see in a company? We talk about which stock exchange it is listed, so you can buy it from the country wherever you're from. How much debt the company has, what is the price to earnings ratio of the company. You have lots of ratios, lots of stuff you can set as your screeners, and once you hit that enter button, you will have the search results, and Ticker will show you all the companies that match your criteria, and usually that's pretty interesting stuff. And maybe I will show you someday more deeply how I do my research exactly on ticker.com. At the moment, that's the service I'm paying for. They are not paying me anything, so this was not an advertisement, just saying I think that's the best website, in my opinion, I have come across at the moment. So for screener search, I use ticker.com, and obviously this is very analytical way of starting your stock research, company research, going with the screener. All these three, I'm not saying which one of these three is the best one. You should pick ideas, I think, from each of them and observe each of them. But let's move downwards now in the graph, and first arrows lead us to the interesting company found. So now I have found a company. Let's say that I'm going to use an example of my portfolio, one company I have there now. For example, Crocs. I saw everybody on the streets, summer festivals this year in Finland wearing Crocs, and I got curious, why is everybody having them? Why is everybody wearing them? And turns out, after digging some screener, for example, making a screener search too, I came across Crocs as a possible target, possible cheap company at the moment. So now I have found an interesting company. What do I do next? We move to the yellow box. There's two things I'm going to do. I'm going to do a discounted cash flow valuation to check whether the company is cheap, in my opinion, or not. And then number two, I will study it on Arctic Money criteria. If you have checked my earlier videos, Arctic Money criteria is something you know. You know what is Arctic Money criteria about? What do I check in Arctic Money criteria? Basically, I check: do I understand the company? Does the company have a moat? Have super investors been buying it? Have people who I follow been buying it? Have insiders been buying it? I'm not going to go more deeper into that, because you can go and check any of my other videos where I do this Arctic Money criteria. So go and check another video and you will know what it is if you don't know yet. For example, go and watch my Crocs video here on YouTube, and I will run Crocs through that Arctic Money criteria, so you know what I'm talking about, even though I mentioned to you the points over there already. Okay, you go and check that one out, but we move forward now. We have on the left hand side from the yellow box, we have two orange text saying that if the company is overvalued according to my discounted cash flow valuation, I leave it to my notes to maybe return later when the stock price goes down. Obviously, if it's too expensive by a big margin, I'm not going to spend any more time on that. I just say that the stock is too expensive, way too expensive, so no reason to dig any deeper at this point, and maybe let's return later when the stock price has moved down. And then the other box, orange box, if not something I can understand, I leave it to my maybe return later list. Maybe return later list or not. So if this is where a company, well, Crocs is making footwear, so it's a footwear retail, pretty easy for me at least to understand as a person who has working experience in retail, easy for me. But There has been more difficult companies for me, like Flow Traders and Intel, which I own. Both are more difficult for me. I needed to study them a great deal more than Crocs from the beginning. But let's say that, for example, for me, banks and insurance are two industries I don't think I understand. So I'm not gonna look into those industries, companies in those industries, because, well, this is so obvious to everyone listening and watching this video. If you don't understand what the company is doing, what is their business, you have no business in investing in that company. You do need to know what they're doing, what it is that they do to make money, and I advise, the world is filled with great companies in various industries, so maybe don't go investing in something you don't understand. That's a fool's game in the end. So, but now let's move onwards. So yellow box, we see the first black box. Now I have found that Crocs is cheap, and Crocs is something I understand or could understand after more studying. Yeah, like I did with Intel and Flow Traders there. But yeah, I think Crocs is cheap. I understand their business. Then we move right to the next black box. I place it on my watch list and deep dive into it. Well, now I have the DCF made. Now I have the Arctic Money criteria made on the company. And now I basically, this is freestyle research. You read everything you need to know about the company. You can look for resources online. Of course, annual reports, if probably want to listen to some of the latest earnings calls, maybe look at annual reports, even though I understand annual reports are long and boring. Maybe still something worth doing if you don't get this information in more concise way, let's say so. Anyway, this second black box is freestyle researching of the stock of the company. You read everything there is to read about it, and once you feel comfortable, then you feel comfortable. You know, you get the feeling that I know the company now, and we move to the bluish box below. If I determine I understand the company, yes, I understand Crocs now. It looks cheap, yes, Crocs looks cheap, and it fits to my portfolio from the risk side. What market, what industry, how would it correlate with other stocks in my portfolio? Would it possibly be a hedge for some other company I own? This is we already discussed understanding the company. We already discussed it needs to be cheap, obviously. But then there is the final third part, which I wanted to include here, is that it needs to fit to the portfolio. Just a quick example. If my portfolio would have 50% already in Nike, Adidas, and Puma, and then I add Crocs to there, you see that these all basically operate in the same industry, footwear or athletic wear. These Nike and Adidas, Puma obviously have clothing and stuff also, but if you have their Crocs, you have their Steve Madden, and you have their, I don't know, what would be a third footwear company, then your portfolio might be too risky on the retail side and especially in the footwear side. So you want diversification to some extent is needed by all investors, even the ones who have only 5 positions or something. It is not advisable to have all your money. Well, you can do whatever with what you want with your money, but I wouldn't be comfortable in having 50% of my money in one industry, since world is a crazy place and anything can happen and your industry can become obsolete overnight if the worst thing happens. So you understand what I mean. If you want to buy a new company to your portfolio, it needs to fit there. It can't create too much of a risk side of concentrating too much on one industry or one country, for example. This is the final thing to consider. Pretty obvious, but needed to be said here. Let's move forward to I have written here on gray that setting of buy price target and plan for dollar cost averaging. So basically I already had my valuation done, and now I lock in what is my buy target for the company. Let's say for Crocs, I can't remember. Actually it was, I think, the same buy price target, $54, as the company is trading actually today. I just happened to check it. So let's, if I remember correctly this one, let's just say that my buy target for Crocs was $54. And then that's set, and basically That's the before the stock is $54. I'm not gonna buy it, but once it hit that number, then we move forward. But what do I mean by dollar cost averaging there on the gray? I want to tackle that one too here. Basically, if I first buy it at 54 and then Crocs suddenly plummets down to $35, I need to be already a little bit thinking how much money can I put into Crocs, how much dollars, euros, yens, whatever I'm gonna set aside for the Crocs stock price to go even lower levels, which all stocks definitely can do. But you need to have some kind of strategy that you're not pouring 100% of all the money you are intending to invest in Crocs. You can do it. You can obviously do it. Nothing against that, I guess. But me, I want to reserve a little bit more money for Crocs. If the price moves more down from 54, becomes 40, I want to buy more. Becomes 30, I want to buy definitely more. If nothing big has happened, obviously, with the company, the business is as it is, and the stock price decline is not justified by fundamentals, then I do want to spend more money on Crocs. I do want to buy more money. So dollar cost averaging strategy, you need to already a little bit think about the future. What will I do if this stock goes lower than $54, significantly lower even? Never mind. Let's move to the green box. So we have the buy price target now triggered and no better alternatives in my portfolio. Then I buy Crocs stock. By no better alternatives, I mean that, as all of you surely know, stock market tends to move in tandem, either downwards or upwards in big trends. So might be that Crocs goes to $54, but at the same time something else in my portfolio is looking even cheaper, even better deals. So obviously I need to prioritize that over Crocs. But if that is not the case here, and no better alternatives, no clearly better alternatives in my portfolio exist, or outside my portfolio if I'm monitoring other stocks, well, you understand what I mean here, then the buy price target is triggered, and that's a happy day. Then I'm gonna become a Crocs owner. With that price, my valuation says I should do it. Now I'm an owner of Crocs. Now I have it in my portfolio. Then I move to the blue box underneath the green box. Constant monitoring of the company and industry, continuous learning. Obviously, the learning process never stops. You keep following Crocs as a company. You keep following what they say, what the news say about the company, about their products, what are their plans for the future. Especially you're gonna follow if something changes in the company's way of doing things. For example, we have been using Crocs as an example here, so let's continue. Crocs is a footwear company. If they would announce tomorrow that they will go into making t-shirts and jeans too, that would be a huge change for the company. Now they have Crocs branded shoes, and they just bought Hey Dude brand of shoes, but still, even though they have now two brands underneath them, they both are footwear, closely related to each other. But I would say that if Crocs starts doing t-shirts or jeans, that would be a major change in the company, and I would need to re-evaluate myself. Is this something I want to own still? Is this something I agree with the management at the company that this is a good thing? Obviously, it's you want to trust the management to have the best insight that this is something we should be entering, but history has many cases of companies moving outside their own industry, and when you start playing sports you haven't played before, let's say, so many things can go wrong, and many things have gone wrong for companies who have been growing too big and entering too many industries. Usually you are successful when you find your own niche and you have a moat to defend that niche from competitors. Those are the characteristics of a great company, in my opinion. Much rather would own a company that concentrates on few things than a company that is doing hundreds of things. Too much work to even follow, actually, if they do too many things. You cannot be expert in everything yourself too. Never mind, with jeans and t-shirts I would really need to think like, yeah, this is still a fashion, so it's not something completely different from Crocs' core business footwear, So that needs to be reevaluated. But then again, if Crocs starts doing something, let's say Crocs starts their own soft drink brand, well, drinks have nothing to do with shoes anymore. That is a completely different industry. The only common thing is that basically they are retail both, but already quite different retail when soft drinks are fast-moving consumer goods. Shoes are not. You don't go buying shoes every week. At least most of us normal people are not doing that, but you might go buying soft drinks every week. You see the difference there. Okay. Constant monitoring of the company and industry, continuous learning, never stops. Then the last gray box beneath, and as you can see, we have now gone through the boxes on the right hand side, the idea generation phase, study phase, decision phase when we decide to buy the stock, and now with constant monitoring of the company and continuous learning, we are at portfolio management phase. And obviously there comes a time that the company stock might go up. You want to see it go up, and when stock prices go up, and if fundamentals of the company, their earnings, their cash flows don't go up, the company becomes, from a good value, from a good investment, the company becomes overvalued even significantly. So once we go north from my valuation, how much I would pay to get 10% return on the company, and you start moving to higher stock prices, then every dollar, every euro we go up is moving me closer towards selling the stock, selling my position on the company, obviously. And once it hits too overvalued, you should obviously sell it and be happy. You're gonna take profits now. In this scenario, you will take profits and you will be happy. And you've just had a great experience. You will probably continue following the company. If the stock price comes down again, you might want to re-enter as an owner. But if not, and it looks too expensive for you, then you're going to say thank you to the company and thank you for the profits received and be very happy, obviously. But then there is also another side of selling, which is fundamental changes in company or industry. For example, this would be Crocs entering the soft drinks business, and I would be completely question mark myself. Why are they doing this? Top management has gone crazy. I don't want to be an owner of this company anymore, so I would need to sell it. Sadly, in this case, the selling would probably happen. On the minus side, I would have lost money while holding the stock. So if fundamental changes happen and the stock price has only declined from where I bought it, then it's a sad thing, and it definitely pisses you off to lock in losses. But this is still something you should do when you lose your grip, lose your understanding of the company. You don't understand anymore what are they doing. You don't understand how they are spending their resources, using their capital. It's not the same company you bought in anymore. So even though it hurts to lock in profits, you need to sell it on losses, and you will lock in those losses. Save what you can save and don't look back anymore. In this case, probably I would pretty much ditch the company, not follow it anymore. So these kind of things happen, and every time it's not an easy decision to sell on the loss side. Has happened to me. I'm not going to say many times because I haven't locked in losses many times. Luckily, there has been a great bull market of 5 years behind us, so not many positions I have sold. I have sold on minus side on losses, but there is the most recent loss I have locked in was obviously the saddest stock I have ever owned, Gazprom, the Russian gas giant, which obviously everything changed when Russia did absolutely stupid things and started a war against innocent Ukraine, and that was a point in time when the stock plummeted. The company was not going to be ever the same company I invested in. The fundamentals I had in gas industry and why I ended up picking Gazprom as a low-cost producer and hoping that Russia would continue developing towards more civilized nation, I would say, I had those hopes. I know many other people had those hopes for Russia too, but turned out they were complete idiots with what they did with Ukraine. So fundamentals changed, and they changed forever. I had no other plan. I had no other choice than to sell it. I locked in minus 50% losses with Gazprom. Actually didn't even hurt too much because I knew that bigger things were happening in the world at the moment and Ukrainians were suffering, so I definitely wasn't too sad for the money lost. Bigger things, more important things were happening in the world, but there is the worst kind of example for you how fundamentals can change very quickly, and it doesn't need to be this dramatic every time. It can be something like I just described to you as a fictional example of Crocs going into soft drinks. Doesn't need to be wars all the time, can be more minor things, and luckily many times they are minor things in the company, but still something you are not comfortable with. But yeah, unfortunately Gazprom was the last time I needed to lock in losses, but as said, didn't hurt me at all because more important things were happening in the world, and not I don't even difficult topic for still to even discuss for me, because you don't, when something like that happens in the world, you are not thinking about your stocks too much, your portfolio too much. You are thinking about innocent people in Ukraine fighting heroically. But yeah, that was a pretty dark turn here in the end of the video, but wanted to share that example because that is real life, that is investing. Sometimes you make bad judgments, you make mistakes. Gazprom for me was a bad mistake, bad judgment by me. I take full responsibility out of it. I'm not ashamed of it. I hope better for Russia as a nation, but they messed things up too badly. And these things happen. That is life. And that is the life of an investor. You need to be prepared literally to everything. And this, in my opinion, goes to the everything category pretty much. But yeah, this was my research process with all the examples I discussed here. I hope this video will help those beginning investors who really don't know where to look for companies, where to look for ideas, and how to systemically approach them. So I hope, even though this picture, I know it looks horrible, so please don't comment it on YouTube. I know it looks ugly. I couldn't make it more pretty, but I hope it has value to you still. And if you have ideas, what would you include in this model? Maybe add to it, maybe take something away from it. I don't know. I would like to hear your suggestions for how to make it better, obviously. And here, if you have some other kind of process you do when you are looking for those companies you want to own, definitely interested in those. So if you have, please share in the comment section below. And if you think this plan is solid, well, guess what? This is what I do every time, basically, with every company. This is how the process flows. If this is the type of investing you like, please continue following the channel Arctic Money. Please subscribe to the channel, it would mean a great deal to me. And if you had the energy to listen to me, watch this video till the end, I thank you for it, and see you in the next video. Bye bye!